that it is Viralacharya's account of his efforts as Deputy Governor of Reserve Bank of India to resist the fiscal dominance undermining the pursuit of financial stability. Quest for restoring financial stability in India makes a proposition around which differences emerge on how independent the central bank should be. The author says that the central bank should be left alone to ensure stability in the financial system. This can be brought about with tight rules and regulations, good governance, and non-interference from the government. The RBI is supposed to have roles that go beyond regulatory oversight. Two fundamental policy issues are often debated while considering monetary policy priorities: whether to stimulate the economy by keeping interest rates low and monetizing government debt, or whether to ensure price stability by keeping inflation rates low. It was believed that early identification of bad debts and their quick resolution were possible through prudent oversight. But the government, and I quote from the book, has been reluctant to allow this to happen, especially during the last 5 years. Dr. Acharya describes a reversal of the healthy trend towards independence of RBI that was discernible in the first decade of this century. There are many more questions and answers that the book throws, and we are going to be capturing a few of them. The book suggests to recapitalize banks, to create a public credit registry, to incorporate financial cycle in the monetary policy framework, to develop viable capital markets, and to enhance the autonomy of the central bank. This and much more in this discussion on policy for financial stability. Ladies and gentlemen, it's my pleasure today to introduce our panel. Our author, Dr. Viralacharya, economist, former Deputy Governor of RBI. He's CV Star Professor of Economics at the Department of Finance at the New York University Stern School of Business and an academic advisor to the Federal Reserve Banks of New York and Philadelphia. He was also a member of the Academic Council of the National Institute of Securities Market and SEBI. Professor Ashima Goyal, Professor Emeritus at IGIDR. She was visiting fellow at the Economic Growth Center, Yale, and a Fulbright Senior Research Fellow at Claremont Graduate University. She's been on several government committees, including Prime Minister's Economic Advisory Council and RBI Technical Advisory Committee for Monetary Policy. Dr. Rupa Rege Nitsure, Chief Economist at L&T Finance Holding. Prior to joining the L&T, she worked as a Chief Economist at Bank of Baroda. She's also worked as a Senior Economist with ICICI. She's also served on the critical committees of Government of India and the Reserve Bank of India. Ms. Sonal Verma, Managing Director and Chief Economist at Nomura. Specializing in the analysis of trends in the Indian economy, she served the Indian government in order to design India's Industrial Production Index and was previously with CRISIL and the ICICI Bank. Dr. Rajeshwari Sengupta, Associate Professor at IGIDR. In the past, she had held research positions at the Institute for Financial Management and Research, which is IFMR, RBI, and the IMF, along with the World Bank in Washington, DC. She was member of the Research Secretariat for the Bankruptcy Law Reforms Committee that recommended the Insolvency and Bankruptcy Code for India. Mr. Dharmakirti Joshi, Chief Economist at CRISIL. With more than 20 years in economic research and consultancy, out of which 11 years spent at NCAER before he moved to the Central Electricity Regulatory Commission in New Delhi, and then with CRISIL. He's a member of the Economic Policy Group of CII and Indian Merchant Chambers. Professor Anant Narayan, Assistant Professor and Head of Public Policy at SPJIMR. He served as Standard Chartered Bank's Regional Head for Financial Markets for ASEAN and South Asia, managing foreign currency, interest rates, commodities, derivatives, and debt capital market businesses across 12 countries, after tenures in fixed income and currencies trading at Deutsche Bank and the Citibank. And our moderator for today's show, Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard, award-winning author and journalist. One of the members of the founding team of Mint. His earlier assignments, he was advising Bandhan Bank on its transformation from a microfinance institution to a universal bank. And Chairman SKOCH Group, Mr. Kocher. Ladies and gentlemen, welcome once again. And with this, I hand the mic over to Tamal.
Thank you, SKOCH, and for giving me yet another opportunity to read this book once again. After a year, normally this kind of tough book I don't read twice. It's year after. But just to handle this today's moderation, I thought let me go through it once again. Dr. Acharya claimed that he burned midnight oil and poured every drop of economic reasoning and persuasion in this book on writing the speeches. So I also burned my midnight oil. Last night I didn't sleep. I was going through it again. Okay. For the record, Dr. Acharya was Deputy Governor between 23rd January 2017 and 23rd July 2019. He stepped down before his actual term ended. And these speeches, it's a collection of speeches with the foreword by Dr. Y.V. Reddy. He's, in his own words, not only his voice, but his lifeblood. So it's very, very passionate. We will hear him and we'll hear others for the next, say, 1 hour, 1.5 hours to even 1 hour 45 minutes, depending on the flow. Policy for financial stability, quest for restoring financial stability in India. The book is the provocation, or rather, the takeoff point, and then after that we will discuss everything else, what's happening all around, because it was written 2 years back, and since then COVID happened, and right now the geopolitics. So everything will come in. And we'll also take a few questions. So those audience, and for me, good evening and good morning, depending on which part of the world you are attending from. For instance, Dr. Acharya, I had to get up early to join us. He's from New York. Sonal is from Singapore, and rest of us are in different parts of India. Audience also will be from different parts of the world. And I don't know whether it's a sheer coincidence or the SKOCH deliberately to celebrate World Women's Day. You don't find so many women on a panel. So that's a very interesting thing and happy thing to say. So here are the rules. Where are the rules? I'll speak the list. Let's start with Dr. Acharya first. Let him talk about financial sector stability, financial policy for financial stability first. Dr. Acharya, probably you speak about 5-6 minutes on this, and then I will come in and ask you also. Right now, the context has changed because of the current geopolitics and the COVID. Are you still sticking to those speeches and the opinion that you had in the book, or you have changed? So overall, probably 10 minutes we'll talk. And then each of the panelists will go alphabetically in a brief way, first round reacting to what Dr. Acharya says. And then we will go play by the ears. I have no script, because this is a happening thing and a lot of interest. And this is a started panel. Over to you, Dr. Acharya, to start. You're on mute. Yeah.
Great. Thank you so much, Tamal, and thank you to SKOCH for featuring the book and inviting me and having this wonderful panel. I look forward to their interactions, and in some ways I hope that this topic would not be of interest to anyone anymore. But I think it remains evergreen, and so here we are. I'm going to offer a view on India's last 15 years, especially. It's a view. We may or may not agree on every single detail that I'm going to present, but I think it's certainly worth a discussion. Let me start with the reforms of 1990s and early 2000s. I think these paved a way for India to embark on a path of high growth, but more importantly, it emboldened the reformers in the country to undertake institutional and market reforms. This included the Fiscal Responsibility and Budget Management Act for fiscal consolidation, the development of government bond markets, both for the center and the state, so that the borrowings could happen at market rates rather than rates forced on banks or set by the central bank. It involved flexible inflation targeting framework in order to build central banks' credibility in managing monetary policy to keep price stability as its anchor, so that external investors and households' inflation expectations could remain anchored. And equally notably, the Sarfazi Act and then the Insolvency and Bankruptcy Code to deal with, in a graceful but prompt manner, the defaulters of the Indian banking system. Yet, in my assessment, in the last 15 years, and especially since the global financial crisis, as growth has been patchy at best, under par, the system as a whole has lost conviction in these reforms. As I politely used to put it at RBI, we have gone back into the chalta hai, adjust kar lo kind of an approach to our financial sector. It's best illustrated in the repeated failure to meet the FRBM targets, continuing use of banks and the central bank to set GSEC and SDL rates, in what I consider as an erosion in the effective operation of monetary policy, where the emphasis or the primacy of the objective has actually pretty much shifted away from inflation back to growth, and dilution of bankruptcy laws in the midst of what was seen as a demonstrated success in getting tough and resolving the bad debts of incumbent industrialists. So how and why did we lose our way? Who better to explain this than Dr. Y.V. Reddy? He was talking about a historical backdrop of fiscal dominance in India, but he described the pre-1990s of India in a very nice way, where the government, the central bank, and the public sector banks kept their accounts as though they were a Hindu undivided family. My sense is that something similar is underway. I would just expand banks to now include financial markets at large. We probably have to now countenance financial dominance in addition to fiscal dominance that Dr. Reddy was talking about. Now, I described a set of reforms. We have pretty much set them aside, or softened them over time, explicitly or implicitly. Yeah, you talk about any one reform in the financial sector, people come up with case-by-case explanations. So these were the compulsions why I had to do it. These were the challenges this year. How could central bank not do anything else? How could the government not do anything else? In my view, when you look at that over a stretch of period, it just starts looking like excuses, and more excuses not to stick to macroeconomic principles for financial stability, for price stability, for fiscal stability. And in the book, I try to explain in the prelude chapter, especially why we need to entertain fiscal dominance in India seriously as a theory of explaining why India and its financial sector and its outcomes are what they are. Because, you can come up with case-specific explanation that doesn't lead to much of a policy. Then you are just putting band-aids all the time on the problems that you have. So let me explain especially why and when fiscal dominance bites India the hardest. There is a time when fiscal dominance is not so bad, and this is when you have large growth shocks, such as the global financial crisis or the pandemic. In these times, long-term and the short-term are the same because you are trying to prevent growth from falling off the precipice. The world over, fiscal and monetary authorities coincided at the outbreak of the global financial crisis and then the pandemic. However, usually a year or two after these shocks are over, things do normalize. Most countries in the world, other than perhaps some frontier countries, are not talking about growth falling off the precipice. The war is a different situation, but I'm just talking about the pre-war, post-pandemic horizon. This is a time, 2 years after the global financial crisis, say 1.5 years after the pandemic, is when you would expect, again, policymakers to start focusing on the long term and not so much constantly on just what is short term. But I think these are the points where, in my view, we basically do not get the policymakers in India to function independently. Now, I think very clearly and strongly that the central bank is not a part of the government. If it was to be part of the government, it would have been an executive office of the government. It is not. It is legislatively not an executive office of the government. There is an act that governs it. There is a legislative mandate that the governors and the board of the central bank have to adhere to. And these are specified in the letter of the law. There is no ambiguity about what is the function of the central bank as far as the letter of the law is concerned. This holds for the judiciary, this holds for the enforcement offices, and this holds for bankruptcy courts and several other things. These are not parts of the government. These are not executive offices of the government. In a democracy, these institutions are supposed to function in a checks and balances sort of a system, so that you balance differing objectives, differing horizons, and by allowing these non-executive offices or the institutions of the country to function in an independent manner, the whole is that the hope is that for the people of the country as a whole, you achieve some long-run stable outcomes. In my view, fiscal dominance, which traditionally is thought of as government weighing down on the central bank in order to essentially help it continuously roll over its debts, in India takes a far more pernicious form. I'm going to focus on the central bank, but I think this broader erosion of institutions also requires some thinking about. Why? Because central bank in India, the Reserve Bank, is an all-purpose central bank. It's in charge of regulation and supervision. It's in charge of debt markets and currency markets. It's in charge of the deposit insurance, so it also gets involved in resolution of failed financial firms and so on. Shock after shock after shock, in case of the RBI, my sense is that first the monetary policy after the global financial crisis, then the regulation and supervision of banks, then the botched monetary experiment of demonetization, the continuing forbearance on small and medium-sized enterprises, the dilution of the bankruptcy code, and in what I now consider as a growth-focused monetary policy rather than an inflation-targeting monetary policy. These are to me just signs that one after the other, we are just serving some other purpose besides what these institutions were designed to serve in the first place. And I think it's because the governments are constantly facing short-term compulsions. This is true the world over. They face elections, they have to be popular, they have to care about their reputations. It is not the job of the non-executive arms of the government to serve that objective. They are meant to perform a different role, in my opinion, other than when the long-term and the short-term are perfectly aligned so that growth doesn't fall off the precipice. If we are perpetually in that situation, the only explanation I can provide is that India is perpetually in a crisis for the last 15 years as far as growth is concerned. I don't think anyone can really justify that based on the levels of growth that we have actually witnessed in the economy. So the only explanation is that precisely what are the compulsions of the government are the compulsions of the economy every 6 months, every 9 months, every 12 months. And I just don't think that passes the smell test of common sense as far as it goes. So in my main sort of talk as the deputy governor, I described it as the discord between playing a T20 versus playing a test match. It requires a very different kind of a player. And I think, I can give you interesting contrasts in an Indian audience, but, you can't have Rahul Dravid be the best T20 player, nor can you have Rohit Sharma be the best test match player. It doesn't work. The only person who did it for a short while was Virendra Sehwag, but his career was far short-lived than that of Rahul Dravid. Now, what have been the consequences of the fiscal dominance of the central bank? In my view, the primary consequence is that because the central bank continuously keeps accommodating or is under pressure to accommodate the short-term needs of the government doesn't deliver on what it is supposed to do. Be it public infrastructure, be it health, be it education, be it the disinvestment programs. Just look at how many times we have missed disinvestment programs in the last 10 years. Just look at the track record. Have we delivered even once I challenge you to show me 1 year when we have met the disinvestment proceeds. Why does that happen? Because we are constantly accommodating the government borrowing program. We are constantly delivering bigger and bigger payouts using all kinds of policies that are possible in order to pay a larger dividend, so that technically the government can say, oh, one of this PSUs, technically it's not a PSU, but that RBI gave it a large dividend to meet the big hole that was created. There are far more pernicious outcomes. In my view, it is not a coincidence that our growth is not picking up, because we have not had a big set of substantial reforms since the Vajpayee era. And why is that? Because we are constantly focused on short-term fixes. No one is actually giving the real message that our growth is not cyclically weak. It is right now structurally weak. You cannot fix structural weakness of growth of an economy with constant monetary stimulus, bandaging of the banking sector and the non-bank financial sector through relaxation of bankruptcy reforms that will help the incumbents stay in control of their assets for a longer period of time. So in my view, the real cost of all this is that everyone else is doing government's function other than the government. The government gets away with not focusing on the long term, is just able to go time by time, just bide over its next challenge, bide over the next auction, bide over the next whatever cliff it has in terms of the local or the national elections. And in the end, it doesn't add up to much as far as delivering on the potential growth of the country is concerned. In the book, I give a sketch of how this plays out in the rest of the system. I think it actually corrupts the rest of the system. Our industrialists are busy, constantly hobnobbing in New Delhi rather than focusing on becoming globally competitive enterprises. We need to have constant tariffs in the country in order to protect these industrialists. Look at it from the outsider's perspective. India's trade policy is basically one of protectionism. It is of nothing else when you look at India's tariffs relative to the rest of the world. So how can we be the global growth giant if we are not willing to embrace the reforms that are required to maintain price, financial, and fiscal stability along the way of creating solid infrastructure, solid jobs, and solid long-term growth. So what's the way out? I'm going to just put one simple idea on the table. How about sticking to the laws we have in place? Okay, I'm going to just put it as a simple principle that I think India needs to adopt. We had an FRBM. We just kept wriggling around it in whichever way possible. We had an insolvency and bankruptcy code. What did we do? Within 2 years, we found ways to dilute it. We have an inflation targeting mandate. Its primacy, it's very clear. Its target is 4% CPI inflation. How about sticking to that? How about doing that for a change? For 15 years, we have disregarded laws. We have gone from being growth hungry to growth anxious to now being growth desperate. In my view, the policy of last 15 years has not worked. So how about trying something that other countries do, which is to respect the letter of the law for their democratic institutions? In our posturing, we always say these laws are important. Flexible inflation targeting is there. We have a well-functioning bankruptcy code. We have FRBM targets. If it's so important to posture that these laws are there, the job, why don't we try to implement them de facto and actually get them to deliver the mandates that they are supposed to be delivered? Why do we find it so expedient and easy to set aside the wisdom of what may have gone in a very complicated lawmaking process when it comes to the implementation of that law? So for now, at the cost of sounding a bit disappointed and critical, I fear that we have just been hobbling from one shock to the next over the last 15 years. We have no clear long-run path or trajectory for the economy. We keep trying to discover a new path every time a new shock arises. It's because we have shifted the focus away from long-run macroeconomic stability targets. I'm not pessimistic, however. There is success in the economy. Just look at our tech services sector, look at our digital finance and its plumbing. It seems many sectors are able to be successful regardless of this all-pervasive fiscal dominance. But again, I think it is no coincidence that these are the sectors where the government, the central bank, the financial sector, especially the banks, are the least directly involved in my view. It's because they are not as affected by fiscal dominance as other sectors of the economy are. But just imagine if month to month, quarter to quarter, year to year, if our central banking was not just focused on meeting the ever expanding financing needs of what I consider a bottomless pit of the revenue expenditures of the government, the central bank could do so much more. That is how I felt when I was in job. And I think it's important for me to convey this for others to consider.
Thanks.
Thank you, Tamal.
Thanks, Dr. Acharya. I thought I'd split into two, but you have actually covered everything, even in the current situation also. So you said you are not pessimistic, but barring the last few sentences, it reeks of pessimism only. Nothing is happening in India. That's the kind of thing. Your view, sitting in New York, but even where you were in India, you were a sort of rebel. I think in your book you said, not I think, your book you said, RBI lost its governor on the altar of financial sector stability. Okay, I don't think anybody else would have the guts to write that. You said that. So in the first round, we'll ask each of the panelists. We have a star-studded panel, and most importantly, Ashima is here, who's a part of not RBI, but RBI's Monetary Policy Committee. I mean, when you talk about fiscal dominance and keeping not inflation targeting at 4%, but 6%, you did not say that. I am saying that 6%. And accommodating government, etc., etc. Ashima will be very keen to hear Ashima also. So let's first round. We'll get into other things later, but first round we'll go alphabetically, and I would like each of you to react to what he says. Do you agree or disagree? It comes. Anant is the first one. Anand, 2-3 minutes. Each of you.
I'll try and keep this really short.
No, not too short, 2, 3, 4 minutes, but on his take, on Dr. Acharya's take from New York.
Yeah. So this is a pure chance that my parents named me AN, and therefore I got first to go. Otherwise, frankly, in this August panel, I should be the last person to speak. I'm not a trained economist. I'm a practitioner, a sinful trader from the past days. So. But to start with, thanks again to the SKOCH. Really great to be on this lovely panel. Dr. Acharya, I have to mention he's a mentor in many ways. He's taught me a lot of things. He continues to teach me a lot of things. So I'm kind of a fan. Nevertheless, I will try and disagree with him on a few things just to make life a little interesting. What you mentioned, Tamal, I think that's the best thing I like about Viral. He's brilliant. Close your ears, Viral. But and on top of that, he has the ability to speak his mind. So even if you disagree with him, he will come with extremely cogent arguments. And I think this country needs that. We need people who can come with cogent arguments and challenge each other's thoughts so that we can come and arrive at the right solution. And more power to you, Viral. I hope you continue doing what you're doing. I largely agree with a lot of what Viral says, but I'm going to try and talk specifically about two things which he mentioned. One, I'm going to talk a little bit about the flexible inflation targeting policy. And I want to take it up as an example of where I'm not convinced that, frankly, an academic institution or an academic framework can really take on the mantle of a long-term, somebody who takes a guardian of the long term as opposed to the short term. I want to talk about the fiscal. I won't talk about the fiscal. I'll instead talk about what Viral mentioned about the real economy, and I'll try and make a few comments about that as well. Let me start with the monetary policy framework. Look, as a practitioner who's dealt in foreign exchange markets and interest rate markets, bond markets, credit markets, and so on and so forth, continues to do so in some ways. It's an extremely complicated context if I was to put myself in RBI's shoes. Okay, the RBI has a whole series of instruments that it can use. Of course, it starts with the policy rate. It starts with the liquidity, amount of banking liquidity it can put or not put. It has intervention in bond markets, in government bond markets. In many other countries, you also have credit markets where central banks intervene into. Then you have the FX markets. And again, you have a whole range of FX instruments, swaps, you have short term, you have a term structure of FX rates as well. In bond markets as well, it's not just the short term, you also have longer end bonds. And you have macroprudential norms, which go along with it, which again are the realm of RBI. And finally, in some cases like the Bank of Japan, you also intervene in equity markets. So there's a whole range of instruments that are at the disposal of the central bank, which in turn has an impact on several financial markets. So liquidity and short-term interest rates impact the money market curves. Your bond intervention impacts the entire range of the bond market, from the short term to the long term to everything in between. Currency markets impact currency rates. Again, entire term structure of currency rates. In case the central bank is impacting equity markets, that as well. And of course, credit markets as well. Finally, all of these interventions which impact these markets have an impact on inflation, on growth, on investments, on employment, on financial stability, on a whole bunch of things. Now we can argue about what the actual impact of each instrument on each outcome is, but there is a correlation, there is an impact. If I was to put this as I'm no academic, but if I was to try and express this is a very, very complex multivariate equation. It's not a simple equation at all. It's like getting into a gigantic locomotive which has all these levers and all these indicators, and it takes a lot of understanding to figure out what you can do to impact what, right? And here is a great rule that, for instance, doctors use as a starting point, which is first rule: do no harm. Do not assume that you know what's going to happen, right? Now, the background to the current flexible inflation targeting regime was we had the Dr. Subbarao period, where unfortunately things got completely out of hand, no fault of his, poor soul. You had, we can argue how much of his fault. Point is, you had a fiscal deficit which went completely out of whack. You had a current account deficit which went out of whack. Inflation went out of whack. Reserves kind of dropped down, and then eventually you had this fragile five and the taper tantrum, etc. So then people decided that, if you leave the central bank in the Dr. Reddy era of multiple indicators, which is looking at multiple things and then trying to figure out what you need to pull to arrive at a financial stability metric, you're lost. And then you'll have fiscal dominance, as Viral says, because if government will sit on you and say, get this done for me, and you'll find a way to justify what the government wants. So this is crazy. Let's have a simple rule-based process. And thereby you had this Urjit Patel report in 2014, which came out, and Rupa was part of that report as well. And then you simplified life. You said, let's make it simple, rule-based, inflation, and then you will use repo rate to control inflation. By the way, 45Z of the RBI Act says that. There is no mention of growth. It just says you will use policy rate, you MPC will use policy rate to arrive at whatever the government sets as your inflation target. That's it. There is no growth, there is no currency markets, there is nothing implied anywhere else, okay? I think this is ridiculous. I think this is, trying to simplify a complex situation like this and boiling it out to one repo rate impacting one inflation, I think is just oversimplification of the worst kind. Now, I'm trying to put myself in Ashima's shoes, and I'm glad I'm not there. But she's been charged with controlling inflation between 2 to 6% using one single instrument, which is the repo rate. She has no control over currency intervention. She has no control over the term structure of interest rates. She has no control over RBI bond intervention. She has no control over macroprudential norms. And believe me, all of this has an impact on inflation, growth, investments, employment, a whole bunch of things. So my fundamental reason why I'm giving this Ram Kahani is the following. Sometimes academic processes which try to oversimplify an extremely complicated position to try and get hold of or try to control fiscal dominance, I suggest can end up with outcomes which are very, very questionable. And at the moment, I think what RBI is doing, and you can call it fiscal dominance, I think there is an element of fiscal dominance. But given that the markets, given that the context is so complex, they're trying to use all these instruments, managing and Tim Bergen principle, which Viral taught me about, which is if you have 6 indicators to control, you need 6 instruments. You're trying to do all of that and then trying to pretend you're still sticking to this lovely framework of flexible inflation targeting. So to me, this process of arriving at such regulations, and we need to have a more open debate about this. All the research I've seen justifying flexible inflation targeting does not answer a simple question. Can you really control inflation in India using just repo rate? I don't think that I have seen any research which actually gets to the crux of that matter. I'm going to keep that aside because I know a lot of learned people on this panel are going to beat me up. Viral definitely is going to beat me up after this goes over. I want to come to the last bit, which is on the real economy. And there I completely agree with Viral. I'm a teacher now. I ask my students, we have a lot of debates about this monetary policy framework, fiscal, FRBM, and I totally agree with Viral there. I wish we had a CBO equivalent in India as well, which was more accountable. I wish we made a lot more noise about cash accounting in budgets, not having enough money into education, and at the same time having all this egregious fudging of accounts earlier in FCI and now in your Discom books in states, etc. But then end of it all, I ask a simple question. Can you tell me what is the monetary policy framework of the People's Bank of China? Or what is the fiscal policy framework that's followed in China? And barring a few economists who have been there, done that, there's a blank look. My simple point is exactly, I guess, what Viral was arriving at. China did not become China because they had a fantastic monetary policy framework or a great fiscal policy framework. They got jobs and output in shape. They created jobs, they created output, they fudged everything else, but they got jobs and output. The end of it all, for us, I think that the answer lies in the real economy as well. While fools like me who have nothing better to do will debate whether monetary policy framework is right or not, end of it all, we need things eventually to translate into jobs and output. If we get that, frankly, the art of managing monetary policy, fiscal policy, all of that can become a lot easier. And to the Viral's point, structurally, we have in the last 15 years struggled to get that basic metric of jobs and output, domestic output, right. If we sort for that, a lot of the problems will get solved.
Thanks.
But I'll stop at Tamalda.
Yeah, thanks, Anand. I'm not going to summarize and waste time. But only one thing I point out that you spoke about, repo is the only instrument which is, well, this is half truth. I mean, what Reserve Bank of India did, they did not even need the MPC's thing, and reverse repo was used. In a liquidity flush situation, reverse repo became actually the policy tool, and reverse repo was cut. MPC was not, without any consideration of, without taking MPC, discussing it at MPC. So anyway, these are all the intricacies. I would love to have kept Ashima actually as a last speaker, but as I say, we go alphabetically. So Ashima, over to you.
Thank you, Tamal. Thank you, SKOCH, for the invitation and for putting together this.
A bit louder.
And for putting together this brilliant panel. Can you hear me now?
Yes.
So I agree with Viral on the importance of regulation and laws, legal, etc., institutional reform for financial stability. But I'm uneasy with the emphasis on structural reforms, since stabilization is the first duty of monetary policy. And flexible inflation targeting, by academic definition, gives weight to growth as well as inflation. That's why it's flexible. It gives you some time to reach the inflation target. And although there is a target of 4%, there's a tolerance band. All this is part of flexibility. And when will you need that flexibility? Except, more than at a time when something like COVID-19 happens. So I think that he talks about repeated shocks, India lurching from one shock to the other. Now, this has been happening in the whole world. And these shocks are aggravated if there are no counter-cyclical measures. Financial stability also worsens. There was a collapse of credit. The corporate bond market, for which inflation targeting was strictly interpreted during the Urjit Patel years, also collapsed. Credit growth collapsed in early 1920. It was just 12% of the previous year. And in this period, when we've had some increase in liquidity and the freeze on payments has abated, despite COVID, financial stability has surprised on the upside. The FSR predictions were not achieved. In the banks surprised on the upside. Even Moody's has noted this, the World Bank. That the Indian financial sector turned out to be more stable than the rest of the world thought because of repeated articulation by past deputy governors and governors. So if the financial sector surprised on the upside, it means there were no structural problems. Liquidity squeeze was the problem. The absence of lender of last resort when ILFS happened. So, and Viral's book talks about it necessary to tighten under quantitative easing when the rest of the world is responding to shocks by relaxing liquidity. But then this makes policy pro-cyclical with respect to the domestic cycle. And monetary policy must respond to the domestic cycle, not to what the US Fed is doing. The book also notices that when you have prudential regulation together with high reserves, and it does not notice that corporate and household leverage in India is half of that of emerging markets. Corporates have been deleveraging. So the Reserve Bank has a lot of instruments to handle external shocks without tightening domestic policy. And in effect, when the Fed was tightening in 2018, again, our policy was tightened. That made things worse. So in the current era, the support measures under COVID are time barred. So they are in line with reforms. Only in the best tradition of macro-prudential regulation, there was some relaxation. And I disagree that there have been no reforms and we've gone back on reform. Recently, we've had the GST after long dithering finally implemented. The IBC has also been implemented recently. Relaxation was only for COVID and it's over now. It's all time barred. Flexible inflation targeting also started in 2016, not with the reforms in the 90s. We are setting up a bad bank, DFI, institutional strengthening continues. And the most important factor is that this has worked despite COVID. You know, people said India had the worst growth shortfall in 2020, but the recent IMF data shows many other countries, many in the West, Italy, France, UK, they've all had a higher growth slowdown in 2020. And then people have said that our good recovery in the past year is due to the large slump that we saw in 2020. But our recovery is better than that of other countries that had a greater slump. So it seems that things are working. Whatever is being done now, the stabilization, counter-cyclical macro policy is working. Outcomes are important after all. And then, in the Indian context, especially when you have supply shocks, when you have good coordination between monetary and fiscal policy acts on the supply side, reduces supply side bottlenecks, inflation comes down. So inflation has stayed within the tolerance band despite the COVID shock and worldwide supply chain bottlenecks, which shows the power of coordination. You know, independence does not mean conflict. It does not mean fighting. It does not mean treating the other as an enemy. I think I'll stop there. Thank you.
Okay, thanks, Ashima. So while Anant was like midway on certain areas, he has his own opinion and not exactly on the same page with Dr. Acharya. And on certain areas, he has certain other opinion. But Ashima is actually taking a different stance. And Dr. Acharya himself plays tennis, but he's very fond of cricket. So, and this book is full of cricket analogy, how government plays T20 and Reserve Bank should play Rahul Dravid five-day test match. Ashima right now played for the central bank. Okay, so now DK, over to you.
Sorry, Tamal, I played for India.
Okay. Ashima played for India. Yes, DK.
Yeah, thank you. It's a pleasure to be here. And I think as you were saying, I also went through I haven't finished the whole book as yet, but I did manage to go through large parts of it. And I think there are many issues that Dr. Acharya raised, which do need attention. But I'm going to look at, I think, in my remarks, I'm going to focus more on the aspect of financial stability, which is the ability of the financial sector to take shocks. And I think since we had one shock and the other one is coming, so in that context, I'll position my remarks. Sure. So I think Warren Buffett had famously said that you only know who is swimming naked when the tide goes down. So the tide did go down in 2021 when we shrank. And we were expecting the banking sector, the NPAs to explode actually. And that did not happen. I mean, and right now, I think the situation is such that some of the non-performing assets, particularly in the corporate sector, I think they are reducing. I mean, and let me try to explain that how some of the reforms actually started during Dr. Acharya's time and even before that have actually helped. So it's not that pessimistic a scenario, so to say. So let's come to the corporate sector. I think it's benefited somewhat from the deleveraging that has happened during the pandemic. The GST regime itself favored the large corporates vis-a-vis the smaller corporates, which faced more compliance burden, and they have not been investing. So it's not a surprise that the financial profiles of the corporates are looking much better. Large corporates are looking much better right now. And where I think the other contribution to the lower NPA pressure from the corporates is due to the asset quality review, the PCA framework, even the CRILEC. I think all this did help to clean up the process of the banking system, so to say. And so that has, I think that has contributed quite a bit. And now coming to the IBC, the contribution of IBC, I agree it's been diluted a bit, but it has structurally changed the mindset in India. I think that we have to agree. In India, it was said that businesses get sick, but never the businessmen. But I think now the businessmen also do fear of getting sick. I mean, because they can lose their companies. The promoters are really worried about that. And we've seen instances where case goes to the IBC and immediately the promoter is trying to return the money to the lender. I mean, so which essentially means that there is some kind of discipline which is coming in. And I think the IBC probably needs to focus more on the sanctity of timelines, etc. And I think and the proportion of debt recovered. But broadly, I think it's moving in the right direction. On the fiscal dominance side, I think Dr. Acharya has a point. Actually, Mervyn King did point out in 2019 in one of the remarks to his book that it's an issue not only for India, but I think globally also. After 2019, I think fiscal dominance is all pervasive. I mean, the debt levels have risen so much that we cannot get back to the pre-pandemic equilibrium rates. I mean, they'll be much, much lower now. So I think one can think of fiscal dominance and having a play there as well. But I want to, I think I'll refer to his book, and I want to highlight two things which Dr. Acharya mentioned on his chapter on fiscal dominance. One was that the government accounts are typically not transparent. And now I think the budget does make some attempt to make the accounts transparent, and many people have commented that you can take them on face value, because the kind of acrobatics that used to happen on food, fertilizer subsidy through bonds, etc. I think that's stopped. So I think there is a lot of movement towards transparency. Second was, I think I read out from his book, I think, which says that you'd noted, I think, in the book that the focus is short term. I mean, which you, I think, now also reiterate. And this it's on expanding it's not on expanding the pie, but on short term needs. But I think the budget, if I look closely, it does make a departure from that. I think government has been fiscally conservative, so it kind of tilts towards the capex spending. So that may reduce the side effects of fiscal dominance to some extent, if at least the money is being used for right purposes. And I think these, I think, do contribute to sustainability of fiscal stance to a limited degree. I think a lot does need to be done. And fiscal FRBM, we've only met the target once in last 30 years. I mean, that was a year of exceptionally high growth. So I do believe that central banks cannot be disconnected from the realm of the government completely. My former boss, Paul Sheard, used to remind me often of a statement by one of the Fed officials that central bank is independent of the government, is independent within the government, but not of it. So basically, within the realm of the policy, I agree with Dr. Acharya that there should be enough operational independence with the central bank to conduct its policy. So let me stop there.
Thanks, DK. I think Ashima will be all smile, because largely you are taking Ashima's stance, and Ashima says he's playing for India and she's playing for India, and she's actually Rohit Sharma, probably, because captain of all 20, 50 years, 50 overs, as well as test cricket, right? You spoke about non-transparent. Yeah, Dr. Acharya's book spoke about accounting jugaad, That's the budget he's talking about accounting to that. But it seems like both you and Ashima are saying that things are changing. It's not correct that we are not doing structural reforms. We have been doing it, etc., etc. And lastly, you said that yes, you are independent, but you are answerable to Parliament. You did not say that, but that's what you meant.
Yeah.
Right.
Yeah.
So yes, Rupa. No. Before Rupa, Rajeshwari. By that, Rajeshwari comes to you. Reacting to Dr. Acharya's comments, and then we'll get into some micro details depending on the time. Yeah.
Yeah. Thank you so much, and I of course want to thank the organizers for inviting me to this esteemed panel. Viral, of course, has made some excellent points, and needless to say, I mostly agree with him, and I do share his pessimism by and large that he has expressed. I would like to make two comments which are primarily related to what he said, but maybe taking a little bit of a different angle. So the first point is again in the context of monetary policy. It's related to the objectives. So the RBI for the longest of time has been overburdened with multiple objectives, right? And we have seen that, we have lived through it. There's been inflation, growth, exchange rate, financial stability, interest rate, the entire gamut of it. Inflation targeting as a law was supposed to relieve the RBI from that burden and define the focus of monetary policy a little bit better, and then put the focus of monetary policy primarily on price stability. And the law says with an eye on growth. So the primary objective of monetary policy is price stability as per the Act. But it has not worked, and we need to ask why. And Viral says one main reason is fiscal dominance, and of course it's very important. But also I think the other reason, and on fiscal dominance itself, I don't think India is unique. For example, if we look around the world, in Western countries, the central banks have significantly expanded their balance sheets in the context of the pandemic. In the US itself, the Fed has expanded balance sheet from, I believe, 4 trillion to 9 trillion. And recently we have seen, despite inflation in the US going to 4-decade high, the Fed has been quite reluctant to increase the interest rate, maybe subject to political pressure. So this whole idea of fiscal dominance, now US may not have fiscal worries that it is concerned about, but the idea of central bank independence being compromised because of political pressures is not something that is unique to India. That's one thing that I wanted to point out. And secondly, I think the reason is, one is of course fiscal dominance. The other reason, to paraphrase a bit, is that governments all around the world are concerned about growth and distribution of income. And they are hoping that somehow the central bank, using its weak monetary policy, will be able to achieve that. So in some sense, the entire responsibility of rescuing the economy seems to have been placed at the feet of the central bank using monetary policy. As long as that continues, and until the governments change the stance that reviving growth is their responsibility through reforms and institutional changes, and not the responsibility of the central bank, I don't think central banks will ever get the autonomy and the independence required to squarely focus on inflation. And the second point I wanted to make, which is related to, I think, what Viral said in context of institutions, while we have passed the law of inflation targeting, and on paper, on a de jure basis, we are an inflation targeting country, do we even have the strong institutions required to implement inflation targeting? For example, transparency and accountability are two very critical pillars of inflation targeting to communicate to the public the credibility of the inflation targeting institution. During the pandemic in 2020, for 3 quarters in a row, the CPI inflation crossed the upper level of 6%. By the law, the RBI is required to send a letter to the parliament. Now, this goes back to DK's point about answerability to the parliament. RBI is supposed to send a letter to the parliament explaining why this happened and what it plans to do going forward, but that, I believe, was not done. On the point of transparency, currently, for example, the 91-day treasury bill rate is close to 3.8%. We now have an effective reverse repo rate, as the governor announced, which is close to 3.9%. So while this is happening, the actual repo rate and the reverse repo rate have not been touched. And of course, the repo rate still, it's not been abolished. So it is imposing some kind of a ceiling on the short-term rate. So they are stuck at 3.8 and 3.9. So it almost seems that the RBI is doing monetary tightening by stealth, while officially maintaining that we are going to keep an accommodative stance as long as it takes. That is a complete lack of clarity about what are the goals of monetary policy and what are the instruments of it. So if RBI is going to follow multiple objectives, and I'm not going to argue into that because that's a very long debate, because I really don't think we are doing inflation targeting. So if RBI has to follow multiple objectives, at the very least, it can communicate that what its objectives are and how it is planning to balance the conflicting goals. and take the MPC into consideration, because recently we have seen that there is an MPC statement, there is a governor communication, and there are a lot of differences between the two. For example, the MPC does not talk about the effective reverse repo rate or this kind of a surreptitious increasing of monetary policy rates that's going on. Whereas MPC is supposed to be in charge of monetary policy under inflation targeting. So I think we are on paper an inflation targeting country. I don't think on a de facto basis we are. The last point I would like to make to Viral is, and to the panel, is that fiscal dominance, the way I see it in India, is reflective of broken politics. There is a lot of political dominance of policies, economic policies. So for example, we have seen recently oil prices have gone up to 130, 140 barrels per barrel, dollar per barrel. But we see that because of state legislative elections, we are not really seeing the effect of the oil prices yet. Now, in that kind of a situation, how can you forecast inflation? Because the central bank does not even know when oil prices will increase and to what extent it will be passed on, and so on and so forth. So there's a clear political dominance of economic policies, which happens maybe in a welfareist, statist economy such as ours, where we're trying to impose a lot of Western kind of reforms on this kind of a structure. But given our weak institutions, we are failing repeatedly. So I'll stop there. And
Thanks, Rajeshwari. I think you have added a new dimension. One, you are talking about why don't you directly raise the reverse repo instead of doing it, what you said, by stealth. I mean, what market believes that this is the way of doing it slowly without creating any disturbance, but achieving the purpose. Anyway, that's a different point of view. And other thing, that new dimension you spoke about, it's fiscal dominance and also the political dominance, the politics of it. Anyway, so next is Rupa, your turn.
Yeah, thank you very much, Tamal and SKOCH Foundation for giving me this opportunity. Well, I had reviewed Dr. Acharya's book when it was published, and I was greatly impressed by it. It's written with tremendous academic rigor and strong sense of conviction. I broadly agree with this first principle of economics, which he also is advocating, that any country, when it has relatively lower fiscal deficit, is always in a better position to implement macroeconomic policies and management. There is no doubt about it. But then, I find certain inconsistencies and systematic biases in some of his recommendations, which I would like to highlight here. Because he, for him, the best solution for this is privatization. Now, privatization of banks. But empirical studies, if you look at the performance of Indian PSBs and private sector banks between 94 and 2011, actually, their performance converged for this long period of time. It started diverging from the global financial crisis of 2008, and it became very marked after 2011. Now, NPA pain in large corporate exposures was equally felt by private sector banks. But unlike public sector banks, they were allowed to exit their corporate exposures much earlier. Also, they had various other avenues to hide their NPAs. Now, I have a simple question. If while most of the large corporate exposures were syndicated by both the public sector and private sector players, how can one blame only public sector banks for serious dilution of underwriting standards? That is my first question. Secondly, it was a very legitimate demand of Reserve Bank of India to have more power and control over public sector banks. But then apparently, there was a delayed action against the erring officials in large and systemically important private sector banks, where RBI had claimed that it has enough powers to deal with private sector players. Also, when so many irregularities were getting reported one after another by large private sector banks, and now also from some large private sector exchanges, etc., in succession, why he has referred to them as idiosyncratic issues and not as a systemic problem. And again, I feel when it comes to equalization of net regulatory burden to different ownership groups, by that I mean private sector, public sector, etc., then why a thought is not given to bring entities other than public sector banks under the purview of Central Vigilance Commission, because they are also raising public deposits. So some of these anomalies I don't understand. And if because of fiscal dominance, if the role of Reserve Bank of India as a financial regulator, if it has weakened, then why privatization of PSBs is being advocated so strongly? Because of fiscal dominance, if regulatory architecture has become weak, then we all know that empirical studies have clearly shown that private sector banks play an efficient role in financial development only under a strong and independent regulatory agency. Then why this is being advocated? Also about structural reforms. All structural reforms entail adjustment costs on the economy if they are not well planned. We have seen that happening in case of GST also. DK also raised this point that how small companies, small and medium corporates faced formidable issues because the IT portals had not stabilized, etc. So I feel while the steps like asset quality review, launching of IBC, public credit registry project with Dr. Acharya himself had brought, they were extremely laudable steps, very effective, and help improve the sense of financial sector stability. The prompt corrective action on uncapitalized banks, PCA action, or the lack of lender of last resort kind of mechanism for NBFCs actually tended to increase the intensity of economic downturn during that time when economy was at the lowest point of growth in the past decade. So how we can say that helped in promoting financial stability during that era? Finally, I feel that this whole debate is being raised during this pandemic time, which cannot be, it is not an event comparable to earlier shocks, even the GFC, because the disruption caused by it has been massive. We have not just lost the means of livelihood, but also lives. And I don't think the pains in the unorganized sector, informal economy are reduced significantly even today. And, even though I have worked on inflation targeting framework and I fully support that framework, I feel that how a central bank will be able to stick to well-designed rules for decision-making under this atmosphere of extreme uncertainty. When we are talking about India's return of fiscal dominance, but if you look at the IMF reports post-pandemic, on an average, all countries have deviated from their rules by 4 to 5% of GDP. So India is not alone in that. And based on, because, and in this kind of, and today this is again followed by geopolitical tensions and war, which has increased the extent of uncertainty. So it is practically impossible today to make forecasts about future output and inflation risks, which India will face, because we always say that monetary policy framework always has a forward-looking approach. Can any one of us say that after 2 months or 3 months, what will be India's growth inflation trade-off, or where will it be? There are wide guesses. So based on behavioral macroeconomic model, some economists are suggesting that central bank actually should not be forward-looking in the times of crisis. It makes sense to adopt policies based on current conditions rather than forecasts. Also, I feel that our budget making exercise, to say some positive things, that definitely, as DK said, it has become more transparent. All of budgetary items now they are explicitly accounting for in the budget, which is a very good thing. This time, even the projections about revenue and expenditure are more conservative. They try to give a push to economy through capex, etc. But I feel they should have focused more on economic stabilization measures, demand stabilization measures, because that is the problem today. And that's why benign interest rate environment has not helped incentivizing investments, private sector investment. And this whole focus on long gestation period infrastructure projects cannot guarantee the kind of recovery which we are aspiring for. And the whole success of this fiscal calculation will be dependent on how strong will be the economic recovery. And from that perspective, I feel that we cannot say with certainty that with the present budget, we will achieve our goals sooner than later. So that uncertainty still continues.
Thanks. Yeah. Thanks, Rupa. I think Rupa too has, as you are even not only you are contradicting certain ideas of Dr. Acharya, but you're seeing he has strong biases also on certain areas. We'll discuss that later, time permitting. But before that, Sonal has been patiently waiting. Sonal, over to you.
Thanks a lot, Tamal. I think my fellow panelists have already covered most of the issues. I mean, I would say that, Dr. Acharya has been a vocal proponent of policy prudence. We've seen this during his tenure in the book and today in his opening remarks. From my side, I think it's not black and white. There are always shades of gray. And, there are aspects on which I would agree with him and aspects on which I would disagree with him. Let me first talk about the areas of disagreement. Now, the issue of, rigid adherence to rules, I think cannot be applied at all times. It should be applicable at most times, but when the house is on fire, you need to douse the fire first and then, worry about things like moral hazard. And I think during the shadow banking crisis, one of the risks at that point in time was rigid adherence to the rule-based policy. And I think at such times, judgment becomes more important because you have to get the patient out of the ICU first. The second aspect, he mentioned, and I completely agree, that growth has disappointed. To what extent should we blame it on purely fiscal dominance? Because if I look at, both EMs as well as DMs, most have been complaining about how growth has fallen. And there have been multiple explanations around this: too much debt, aging population, lower productivity, deglobalization, etc. So, to what extent there's a role for global factors, both in the upcycle we saw during 2004, 2007, and sort of the lost decade we've seen since the GFC. So we need to give some consideration to those factors as well. The third point is on reforms and structural reforms. I think there have been reforms. My fellow panelists mentioned GST, etc. I think even stuff like production-linked incentive scheme, national infrastructure pipeline. In fact, the biggest crib, during the pandemic has been, why is the government so focused on supply side reforms? How will you get growth going if there isn't enough demand side consumption stimulus? So actually the criticism on fiscal policy has been on the other side, and which basically raises the question, what are we missing here? If we are doing some reforms and yet we are not able to get growth, what does it boil down to? Is it that it's going to take more time for growth to show up? Or is it that we are announcing reforms, but there are last mile things that we are not addressing, and therefore the reforms are basically not effective? So I think those are sort of the broader considerations we have to also keep in mind. Let me now come to the areas where I think there are And I'm going to put this in the current context where I think the points that he raises are very relevant today. He started off saying he hopes, his views and the points he made are no longer relevant, but they are. And I think we need to be alert to that. Inflation tolerance has been higher in the last 2 years. Yes, it's been a pandemic, but India is not the only country that's gone through pandemic. If you look through other countries in Asia, inflation hasn't shot up as much. And I think it completely makes sense to tolerate higher inflation in 2020, maybe in 2021, but 2022 with expectations drifting higher is clearly needs an evaluation in terms of the risk reward from this policy stance that we are taking. Second is the management of this entire government borrowing, and with the latest budget and what we know from states borrowing, how are we going to normalize liquidity if the entire focus is on where government bond yields are? And this is a very, very practical challenge we are facing and are going to face in this financial year. So I think this is extremely relevant. The third point from the broader financial stability point of view, I don't think this is a risk right now, but everybody seems to be extremely keen on doing housing loans. So perhaps there is enough risk assessment, credit risk assessment, and it makes sense for home loans to be less than 7%, even though there is some stress in certain pockets on consumption side, incomes haven't grown. But it is during such periods of extreme accommodation where we need to be alert to whether we are sowing the seeds of any future instability. And I think he does raise some very relevant points, which we need to keep in mind because it has an implication on the kind of growth profile that we are going to see going forward.
Thanks, Sonal. So if I keep Dr. Acharya out as an author, the rest of you are the 6 panelists. I think Ashima and DK have more reservations than others. But even if it's on an average, I find that all of you have more reservations than agreement with Dr. Acharya's theories and point of view and all. So we have about now 6:40, so another half an hour times. We'll get into certain micro issues, but before that, in all fairness, it's not a debate, but like Dr. Acharya versus the rest of you, nothing like that. So we don't want to degenerate into that. But before that, I would request Dr. Acharya, if you would like to say something after hearing all of them, few minutes, not long. Would you like to comment on a few minutes on their observations? And then we'll get into some micro pieces. And we'll end, it's a very important thing, which I think all of us would like to ask you, your recommendations in the current scenario. That's the last round. But before that, we'll have a quick few rounds, depending on the time. That's why I would request urge all of you to be as brief as possible. But before that, Dr. Acharya, would you like to respond to any of the observations?
Yeah, no, I think these are great points, and I fully respect everyone's views. I'll just put a few counterpoints, maybe just put facts on the table. I'll leave it to you to assess whether you want to revise your priors based on that or not. And in all fairness, I think by my revealed preference, I quit the job. I felt the system didn't have confidence in my views, neither right around me nor in the broader country. And so at some point you have to take a call whether you might be pouring your lifeblood into it, but if the system doesn't have confidence in you, then are you the right person for the job? Maybe the system should give the chance to someone else. And, in all earnestness, that was the primary reason why I left. And perhaps there is someone in the job who the system has greater confidence in. But I think let me leave that personal thing aside, which is, I think I agree on there not being sort of one instrument to deliver the objectives of monetary policy. In all fairness, though, when I look at the public debate around inflation, it's entirely one-sided. We had inflation surprises during my term, which were on the downside. Inflation was lower than where it was supposed to be. We were getting help from the government, from the rest of the system. No one is getting hell right now at RBI. Okay, you can have inflation at 6%. I'm guaranteeing you, if inflation goes to 6.5%, 7%, wholesale price index is in double digits right now. Not a single person has mentioned this, but it is in double digits. The pass-through could start. The pass-through of oil may start very soon. I'm telling you, the system is biased asymmetrically in favor of growth and away from inflation. In my view, that is what it is supposed to be. Businesses and governments are supposed to be pushing more for growth. In a checks and balances system, the central bank has to rein that in and ensure that whatever has been legislatively set as the target, if you don't like 4%, I'm perfectly fine with it. Change the law. Make it 6%, make it 7%, make it 8%. But don't have a law and then say, listen, this is not my target because I have compulsions right now. No. You can't go and fire a person on the street because you have compulsions right now, because that's not the letter of the law of the country. So, I know this may sound very purist, but the reason why laws exist for financial institutions is because they are supposed to drive the operating mandate of the institution. If you think during the pandemic that is not the right target, the government can go and change the law for 2 years or for 4 years and say, we don't think 4% is the right target anymore. You can't have a law and then do something else and then have communication that doesn't give the market or the households any clear expectations of where the central bank believes the inflation is supposed to be. So I think that is what I'm not saying the job is about just the repo rate. I'm not saying the job is just about, delivering on that. But I'm saying if you have a law, you are a technocrat, you have to respect the legislative mandate. If you don't like it, convince the parliament, convince the government to change the law. That would be my preference. I think a second point here, which is that I know that globally this is a problem. I'm writing academic papers globally, also pushing against excessive monetary policy not having delivered. I'm on Paul Sheard's mailing list. He keeps giving Japan as the example of success of accommodative policy. He pushes for modern monetary theory. Why is Japan the role model of growth and inflation for any country? I really don't agree with Paul Sheard at all. If we want to Japanify the entire world, yes, let's go ahead with the policies that Japanese adopted. Let's have zombie lending. Let's have disinflation, and let's have very poor growth. Let's manage everything, including equity prices, right from the go. I'm completely skeptical that the success of Japan can be used as Paul Sheard uses as the role model for policy for the rest of the world. I think let me pose one danger to Ashima from the policy that you have proposed, which is that I think what you risk right now, and this is sort of my concern for RBI, and it is as much a concern for India as you are concerned for India, which is that I think right now RBI runs a real risk that it's neither going to deliver on growth nor on inflation. And I think the mandate of RBI is to deliver on price stability. I think if RBI doesn't deliver on growth, in my view, that doesn't destroy RBI's credibility as an institution, because that is not the legal mandate of RBI. We can interpret it the way we like. Technocrats can say, I have the right to interpret the mandate as I want. But what matters is what's your credibility as an institution when others are investing money in the country. They are investing money in the country based on central bank's inflation targeting and the ability to meet that objective. I think right now there's a real danger, in my view. It may be precipitated by the oil shock that RBI may fall short on neither having growth, because we are still below the pre-trend levels as far as growth is concerned. I believe we are 7% below the pre-trend growth applied to pre-pandemic, nor are we there on inflation. There's a sense in which why it all seems like it has worked. And I know that because I have spoken to my friends in India. It's because the wealthy in India have become even wealthier during this period. And that's because of the stock market boom. Because they've had the stock market boom, they are all buying houses, they are buying luxury cars. Monetary policy has not touched the informal economy. Monetary policy has not created jobs that were broken down during the pandemic. If monetary policy really wanted to boost growth, it really wanted to boost demand, I think it needed a diagnosis of where did the pandemic hit the hardest and create targeted policies to deliver on that. Instead, monetary policy has done what was convenient, which was to buy a ton of government bonds, create monetary stimulus, which primarily has had a wealth inequality impact. This is happening in the United States as well. I'm not just critical of India. This is exactly the same. It's just that the US had fiscal capacity to simultaneously transfer checks to the very poor in the economy. And that brings me to one point which I want to stress, which is why is there no fiscal capacity to spend? Everyone just says, oh, the government is not doing enough. In my view, we have reached this initial condition over a period of 15 years, because at each point of a shock, we have said we will abandon the FRBM targets. There has been no path of consolidation thereafter, whether it is 2 years, 3 years, 4 years, 5 years after that shock. The only time India had fiscal consolidation over the last 15 years when we had the oil price bonanza after 14-15 oil price crash. And it's no coincidence, in my view, that we had a set of terrible things happen in the economy, one after the other, once that oil price bonanza started gradually disappearing. The moment oil prices hit 70, 80, 90 in India, the fiscal pressures mount. Whether we like it or not, there is pressure on the government and the RBI to work together to bail out the government borrowing program, because there isn't any real consolidation. And I think I agree with Rupa that I fundamentally think the government should not be in public business. You can call it a bias if you want, but I think it's an informed bias. I'm looking at average performances of public sector companies and private sector companies. I'm not at all denying there is a Yes Bank and there are housing finance companies that are massive problems in the private sector. There are huge governance issues. The point is that on average, look at the depositor behavior in India. The depositors actually enjoy stronger guarantees in public sector banks. Where are the deposit flows going? In Tamal's book, he shows that more than 80% of the new deposits are actually going in private sector banks. It is because they are providing better services to the consumer. My driver moved out of a public sector bank into a private bank because he was not getting the quality of banking services that he was desirous of. So in my view, why India needs disinvestment is not because I think purely that private sector enterprises on average run better. I think it's because India needs to fund its expenditures through non-debt borrowing programs. The moment it starts relying more and more on debt, it creates a natural point for compromising RBI's inflation policies. See, there are no Chinese walls inside a governor's mind. So if you are asked to target inflation and simultaneously you have to manage the debt program, you can see how a governor of a central bank is going to act. He's going to balance the two objectives. He has two deputy governors, one in charge of monetary policy, the other in charge of the debt management program, coming to his office with exactly conflicting advice on what he should be doing with the monetary stimulus right now. One is saying, take off monetary stimulus. The other is saying, no, provide monetary stimulus so that I can clear the auction. That's going to be an inherent compromise. So I'm in favor of disinvestments primarily to actually reduce government's reliance on debt borrowing. Just one last point, if I can make, and I'll finish there, which is on the ILFS. I think the system is very critical of us. I could see that. Let me just tell you, I tried to say it in 2 pages in the book without taking names, but I will just say it openly here. In our opinion, there were real bad apples in the non-bank financial systems. We spoke to analysts, we spoke to short sellers, we spoke to our supervisors. We knew there was a triumvirate, I will not take the names of these companies, that were doing a ring around to hide their losses. We did provide liquidity, we did expand. That was the time when we moved gradually from deficit to a surplus system. We did not provide direct liquidity because we knew there were bad apples in the system. Some of them are still coming out and some of them are still under judicial investigation as we speak. We did not want the central bank to get into a situation of lending directly to bad apples in the system. There was one way out, which was to do AQR of the NBFC system and then do it. There was no support for that politically. Okay, I'm stating this on record. We would not have been allowed to do an AQR of the NBFC system at that point of time. And why is that? Because no one wanted bad news to come out. There was an election in 6 months' time. I'm sorry, I'm going to say this. There was an election coming out. The only reason why we wanted to do stimulus of the NBFC system was to paper over the problems exactly the way we papered over the NPA problems for several times in the period before. My question is the following. If NBFCs were healthy, why weren't banks lending to them when they had all the liquidity in the world from RBI to do it? What we wanted was that there should be lending even to the bad parts of the system. And I'm just sorry. We had just come out of a 5-year problem of lending to bad corporations. We have seen the fruits of that. I agree that we have now deleveraged and the system is not in that problem. And I'm glad that many of you think the reforms we put in place were actually contributing to this. I wish there was more such support when we were actually in office for this. There wasn't actually when we were in office. All of these were seen as very constraining reforms to growth. But we have seen what happens when you allow lending to bad organizations. I don't think moral hazard is something you can ignore even in the midst of a crisis. We try to fiscally stimulate by lending to bad companies, and we have been paying for it for the last decade. Our point was, if banks can scrutinize the NBFCs and figure out who to lend to, let them do it. We will give them as much liquidity that they want. And actually, by the way, this is the approach RBI has always followed in lending to NBFCs. Correct me if I'm wrong, but even in the last monetary stimulus, RBI has not lent directly to the NBFCs. But I could be wrong. I think RBI has lent indirectly to the NBFCs via the banking system. It has not lent directly to the NBFCs. So what we did was no different than the monetary stimulus of the last year.
Thanks, Dr.
Let me stop there.
Thanks for being so candid and spilling the beans and even giving a peek into what happens in the governor's room when he's with two deputy governors. We'll quickly cut into, because we are close to 7:57. But this 3 minutes or 2 minutes, I would like Ashima to come in before we get into some micro discussion, because Dr. Acharya says that RBI is challenged now. Now it's time to decide between growth and inflation. You can't have both, and you end up making it a mess. Because nobody, even if growth doesn't happen, nobody is going to blame central bank, but you must stick to inflation targeting. That's what essentially Dr. Acharya said. So Ashima, being a member of MPC, just 2 minutes, I want your comment on that. And then we'll cut into a few pieces, micro pieces. Yeah,
I'm just switched to this microphone. Can you hear me?
Yes.
Yeah,
absolutely
so
fine.
Good. Yeah, I want to reply to Viral that there are all kinds of pressures, but I assure him and the panel that the RBI is fully focused on inflation targeting, that even in this very difficult period, inflation has stayed within the tolerance band. But when inflation is largely caused by supply shocks, if you tighten demand, then there's a very large output sacrifice. That's what theory tells us. We have a lot of unemployment. So you don't take that route to reduce inflation, but you signal that you are in that band, you're serious about it, and you have coordination with the government. For example, they cut fuel taxes. Now, after the 14, when fuel prices crashed, they raised taxes. Even in the COVID period, they kept taxes high because the tax revenues had fallen. They raised a lot of taxes from oil. And so now as revenues become buoyant, if you use oil taxes counter-cyclically, you have some room to absorb the pain of a rise in oil prices if it is going to be temporary. If it is going to be permanent and persistent, of course, you have to take that output sacrifice. So we will see how it evolves. And I would like to tell them also that the government, as well as the public at large in India, is very, very committed to inflation. It is not a pressure on growth only. There's huge pressure on the RBI. Just see in this panel, for example, whenever inflation. So remember that we have stayed in the tolerance band in a very difficult time. It is a difficult time for monetary policy, but I think inflation targeting, flexible inflation targeting will help us deliver. Yeah.
Thanks, Ashima. Very, very reassuring to hear from you, an MPC member.
And there are other supply side, like this Gati Shakti, they're reducing logistics costs in India. So a lot of supply side that reduce bottlenecks, keep inflation lower. Yeah.
Okay.
And also we don't have the wage pressures that you see in the US.
Thank you. So the audience, you are hearing one MPC member, that commitment is unwavering to inflation targeting. Now let's quickly 2-3 issues. One is Rupa already discussed, and Rupa raised, her objection to it, but others I would like to hear. Any of you has that what Dr. Acharya used, reprivatization of PSU banks. So Dr. Acharya has already said, Rupa said she has her reservations about it. Meanwhile, the last budget spoke about 2 public sector banks will be privatized. They have not been done, so I don't know what the work is on. So any of you, Sonal, DK, Anand, Rajeshwari, 4 of you, can you tell us what's your view on that? Sonal, start with you.
Yeah, so I'll keep it short. I think with elections approaching, I would presume this is more on the back burner for now. But as a concept, I don't think privatization is like a magic wand that solves all the problems. So what you're looking at is essentially a more efficient organization with less interference, greater productivity, and various other characteristics that you would want in an enterprise. Maybe it comes in with privatization, maybe it doesn't. But to my mind, privatization is not necessarily reform.
Okay.
Can I add?
Yeah.
Quickly, and I'll add to what Sonal mentioned. I'm kind of with Viral on this one. I refer to the PJ Naik committee report of 2014 May. I think that's the best document I've seen, which makes a case. It's not a privatization document, but it talks about the fact that your NPAs are higher in public sector enterprises, possibly because of fiscal dominance of some form, political dominance of some form. It's not efficient. Your Dinesh Khara gets 40 lakhs an annum, which makes no sense for the size of his balance sheet that he's running. The point is, if you can at least bring, like in the case of DBS, in Singapore, which is supposed to be owned by the government of Singapore, but yet has some kind of operational autonomy so that the government does not kind of interact on a daily basis. So if you have a bank investment company, if you bring public sector enterprises under the Companies Act, bring it under one regulator of the RBI rather than DFS and RBI, I think it will do a world of good. So even if you don't do privatization, at least give them functional autonomy and allow them to operate as commercial enterprises.
Rajeshwari, you wanted to come in? Yes, please.
I agree with Viral, because I think what happens when you have a large chunk of public sector banks and private banks as well simultaneously operating, it does not create a level playing field as far as banking regulation is concerned. Because then what happens is, if the public sector banks have a large amount of NPAs, then the RBI presumably comes under pressure to not let the banks disclose the NPA, because the banks disclosing the NPAs would then mean that the government would have to recapitalize the bank as the main shareholder. And that puts pressure on the government's fiscal. So then there is a more incentive to push the entire thing out in the future, so that nobody gets to disclose the bad news, because the entire thing gets hijacked by 70% of the banking sector, which is owned by the government. And also the corollary effect of what that happens is, if you have such a large part of the banking sector under government ownership, as we have seen and we have heard anecdotal evidence of, there's a lot of phone lending that happens. You get calls from the ministers saying you have to lend to such and such industrial houses, irrespective of their financial viability. And then when the loans go bad, there is once again no recognition, because again, there is a whole moral hazard that is creeping in. So I think that by very presence, public sector banks create inefficiency in the system. I'm not saying it's a panacea to just privatize. I think there also needs to be a lot of changes to Banking Regulation Act simultaneously in order to create a well-performing competitive banking system. But I would not rule out privatization. I think both of them.
Thanks. Yeah, both. Viral, Dr. Acharya's book not only talk about reprivatization, he also spoke about the dual control that should be, which former governors repeatedly had been talking about. Rupa, you wanted to say something, then
yes,
Ashima
because
also.
my position was misunderstood. I'm not an advocate of public sector banks or anything. What I'm saying that if fiscal dominance has weakened the regulatory apparatus, then how can we say that privatization will give us better outcomes? And we have seen that it has not given. Secondly, you have to take into account the developmental needs of India. Today, you know, your Janadhan Yojana or so many flagship schemes, government is making use of public sector banks to implement those. Which private sector banks will willingly do that? Even private priority sector lending targets are not achieved by them most of the times, and they have to pay fines, this and that. So point is that improving the governance, corporate governance, and that was the crux of Dr. PJ Nayak's committee report. And another thing I want to say that, see how on DFI structure we have come full circle. You know, we have done away with that structure, and then we were left with no institutions to take care of project finance, infrastructure finance. Commercial banks, including private banks, could not manage it. Similarly, I feel that if we do away with institutions, there will be a whole gap in the whole financial intermediation process.
Okay. Thanks,
And
Rupa.
you know, private sector banks will run it as a portfolio management company.
Thanks.
When certain
Thanks,
things is
Rupa.
not
Yeah.
earning this thing, they will chop off that business.
Ashima, you wanted to put in.
I agree with Rupa. And for those who come from ideological positions on privatization, I think they must remember the Indian context. We have a very diverse population. And also for financial stability, diversity helps. So institutions that take different views, but their better governance is important. And I joined IDBI Bank as a director because I wanted to understand NPAs. It had the largest NPAs. And I saw that they are very serious about reform. They're lending to retail. They're doing risk-based lending. So I was not surprised when the RBI and the FSR got the NPA number wrong. They had done very good provisioning and it came down. So good regulations I find public sector banks are more serious about regulations. They follow the letter of compliance much more than private sector banks, which try to follow, find loopways and so on. Yeah.
Okay.
Okay.
DK, you want to add anything?
Yeah, just wanted to say that anyway, I think in India, the share of private sector in the overall business is rising. So in some sense, the efficiency in the banking sector is rising now. Privatization will speed up that process. There's no doubt about it. And if you follow the PJ Nayak committee reports, I think that's going to make the system more efficient. So both these are going to make the system more efficient. And I think you can choose. I mean, you have to do either. I mean, you can't be sitting in between. I mean.
Thanks, DK. Just a piece of information is this. I mean, you can continue to say that PSU bank share is now come down from 70 to probably 60, 62 odd. But incrementally, you will see they're much, much less. I think close to between 70 and 80% between both for assets and liabilities are for private sector banks. Yeah. Okay, with private sector.
One point, Tamal, if there is time.
Please.
No, I just wanted to give you a very concrete example because no one actually spoke about it. I don't have an ideological position. Ashima.
Please, quickly.
There is a lot of data. There is data on productivity. There is data on NPAs. And Rupa, for everything you said, the NPAs at public banks on average have been far in excess of private sector banks. Yes, there is a rogue private sector bank. It is being fixed. The other two, where the CEO, MDs, you can debate whether they were fired in time or not. They are out and they have turned around. Both of those banks have now turned around. We don't have that ability, even with a weak regulator. I do consider RBI a weak banking regulator, having seen what I saw. It does get the messages late. It does react late. But even with its lateness, it's able to actually turn around those banks. Whereas in public sector banks, that's much, much harder. And I'll just give one concrete example of how a regulation, to Rajeshwari's point, how a system-wide regulation gets botched. We were supposed to move to IFRS, what is it called? The IFRS, the IFRS accounting system for banks. Yeah. It was supposed to do expected loss provisioning. Yeah, you have to provision for losses ahead of time. You can't do it after the losses have arisen. We are still stuck in the 70s and 80s system of provisioning. The entire private system had prepared to move to IFRS. Okay, one fine day, it was decided that this will not happen. You can put 2 and 2 together as to why this didn't happen. Okay, because some of our public sector banks, I won't take names, would have actually started reporting losses under the IFRS system. We could have adopted the IFRS system because Basel allows you to do a 5-year phase-in of the capital that is required under the new system. But there was 6 months down the line, a big event was happening nationally. and there was no capital to be laid out in those 6 months in addition to the banks. An act has to be changed in India to change the accounting system of public sector banks. Public sector banks are required to file their accounts as per an act of the government of India. It's not something that the accounting system determines. It's something that the finance ministry decides how the accounts of public sector banks will be reported. There is a pro forma statement under the act, the BR Act. So unless you change that, India cannot adopt IFRS. So in my view, how can a banking system move forward when you have these kinds of complete idiosyncrasies which are in the system? And so I think this is all anachronistic to say that a publicly listed entity's accounting statement should be based on an act of parliament. This is an anachronistic system. You know, how can we have minority investors owning shares of this company? And it's not the accounting boards or the securities regulator who decides how they are going to report their accounts.
Thanks. I'm sorry.
Sorry. We can go on.
It's 8:10 India time. We're running out of time. There are a lot of things to discuss.
Sorry.
Before we come to the last round, your recommendations in the current context, I want one particular thing, maybe 1 minute each. Dr. Acharya has already said, but rest of you, his book has been talking about repeatedly the pressure on RBI unabated and intensified. And then he spoke about how RBI manages the government borrowing program. I mean, the cost of borrowing program. And then he says RBI has been continuing in its role as a debt manager. So I think his implication is this: RBI should not be the government's debt manager. So I would like each of you to just have a minute of each. Anand, beginning you, because you were handling treasury also, right, in Standard Chartered.
I thought this time will be reverse way from Sonal, but
so one minute each, please, Anand.
So I do think having a separate borrowing office, as I think one already exists in Delhi in a rudimentary shape, does make sense. By the way, lots of countries, for instance, France has a separate treasury, which does the borrowing program. It's not the central bank which does the borrowing program. I think it does make sense. But this fundamental issue will always remain, Tamalda. Even if you have a separate entity which is doing the borrowing program, nothing stops a government from calling up the RBI and saying, dude, I have a problem and I need you to manage interest rates for me. One of the central bankers I really respect was Dr. Reddy. So I think you ultimately need people of the caliber of Dr. Reddy who can manage these tensions properly. Raise your voice when required, lower your voice when required, but actually manage these tensions.
Okay, Rajeshwari, separate debt. RBI should not be involved in managing government debt.
Completely agree. I think there was a time when the PDMA reform was discussed at length, and I have no idea what happened to that discussion. I think we need to bring that discussion back on the table. But I do agree with Anand that it's not just about doing a reform and setting up a PDMA, because the way things are going, even with that, it's highly possible that RBI will go back to doing what it is doing. End of the day, I think it boils down to the government fixing its finances and putting that house in order so that the fiscal does not go completely out of control and put pressure.
Sonal?
Yeah, no, I would agree on this. I think the risks around inflation are much more significant than we are giving it credit for. So I am completely in favor.
Okay. At least on one point, everybody is agreeing with Dr. Acharya. Rupa?
I also completely agree with separation of these offices, and I want inflation targeting framework to come back in full spirit.
DK? Should RBI continue to be involved in managing government debt?
Well, I think if the debt management function is separated, I think some of the problems that Dr. Acharya is mentioning will probably go away. I mean, if it is implemented in letter and spirit.
Okay. Last word coming from MPC member Ashima Gwen.
If a public debt management office becomes more efficient and more market oriented, it's desirable. But I would just flag that in the US and UK, where they talked about the separation, when public debt went up, it came back to the central bank because it needs to be managed smoothly. You know, when you have a crisis and debt goes up, and the way to bring it down is to have real interest rates less than growth rate, that snowball effect. And in emerging markets, particularly, you need to reduce volatility of both real interests and growth. I think the institution which is critical for India now is a Fiscal Council. And this more for the state level, where there's a lot of inefficiency, for improving accounting system standards at the state level. Because, you know, Rajiv Gandhi used to say that 15 paise of government spending goes to the person who it's targeted for. Now maybe it's increased to 50 paise. But there is still a lot of leakage at state levels. You need much more transparency, the institution building. That is the most critical institution currently in the Indian context.
Thanks, Ashima. We are almost 8:15, so we decided to close it between 8:15 and 8:30. So in the best case scenario, we have about 10 minutes left, because then the Shamir, co-chair of SKOCH, will come to conclude it with his comment on Thanksgiving. So the last round is, I would ask each of you to give your suggestions, which including Dr. Acharya. And I will start with Dr. Acharya, and I'll end with Ashima, because Ashima, you are some way representing you are representing India, of course, but you are an MPC member. So in the current scenario, we saw that immediately February Reserve Bank of India policy, it continues to be extremely accommodative. There is no change in the stance, barring one MPC member who is pretty vocal about it. The rest of them are all okay things, and since then things have changed. I mean, I'm talking about the geopolitical situation is this. So Reserve Bank of India's 4.5% inflation target, it seems to be, and Dr. Acharya's book is talking about always, essentially RBI is off the target. It's always on the downside when in inflation targeting. So now we are running the risk of, once again, this 4.5% inflation targeting probably will not work. We are scared probably a higher inflation staring at. We do not know whether it's temporary, will continue. We are talking about current account deficit. We are talking about growth, everything. So at this current scenario, and then the next April policy is coming over. So I would like each of you just a minute or maximum 1.5 minutes. What would be your advice? And of course, keeping in mind the overall theme of the discussion, which is Dr. Acharya's book, Quest for Restoring Financial Stability in India. So financial stability is the broad spectrum, it remains. What should Reserve Bank of India do in April and going forward? First, Dr. Acharya. Just 1 minute, sir.
Yeah, 3 points. One, I think RBI should, in my opinion, change its stance to neutral and then raise rates just to signal to the market that it means business on inflation. I think just saying that it means business is not good enough. I think actions speak louder than words. Second, I think the government will have to find resources to transfer to the poor segments of the society. Dr. Rangarajan has proposed a tax right at the top. I think it's a good idea because it's really been, that's where all the wealth has been transferred post-pandemic, in my view, through monetary policy. And there was a huge tax cut for corporations prior to that. Yes, it's helped them, they've deleveraged, that's good. But you need the last mile person to be able to spend and consume. Their wages are actually getting eroded at the present levels of inflation. So in my view, the fact that their wages are not rising while inflation is rising is actually bad news for the economy. It's not good news for the economy. Let me just stop with those two.
Okay, so Rupa, over to you. 1 minute,
first,
3 points.
Yeah. Yes, first of all, I want the inflation targeting framework to again to be followed in a full letter and spirit, and to begin with changing the accommodative stance, because it is no more helping stabilize conditions. Actually, it have started going up, responding to fundamentals. So it's making actually policy apparatus more ineffective. So better to fulfill the rational expectations of market participants and make the whole framework more predictable. Secondly, need for independent fiscal council, both at the central government and state government levels, because that council should make the underlying macroeconomic framework more consistent with fiscal calculations, which is not the case. For instance, the oil price assumed in budget making exercise was less than $70 when it was closer to $90. So, those kind of distortions could be remedied. Thirdly, we need to do, give direct support to unorganized sector and informal economy, especially Manrega and all, because rural demand is, it will act as a major deterrent for growth going forward. Doing that is absolutely whatever the precondition if you want, growth to recover.
Thanks.
And fourthly, about IBC, because the IBC the requirement is for 360 judges, and currently there are only 60 judges. So they have to scale up IBC because
Sure.
it has proved to be an effective mechanism.
Thanks, Rupa. Sonal, 1 minute. Key 3-4 suggestions. 1 minute.
Okay, so first, I think macro stability and regain credibility. I think there's one thing saying that inflation is high, but it's supply side, and therefore I will look through. It's another to basically say that inflation is all base effect and is going to come down to 4, and therefore we are supporting growth. So I think the Reserve Bank needs to regain its credibility on the inflation targeting framework. There has been flip-flop on reverse repo, which was supposed to be the liquidity tool and now can only be changed when the stance change. So I think that credibility is number one. Second, linked to that, I think stance needs to change. The macro environment has changed. Policy needs to be normalized. We are no longer living in the emergency settings. Policy cannot be in emergency. And third, more broadly, Tamal, I think fiscal clearly is extremely important. From a more medium-term perspective, we actually haven't seen any clear game plan both on the revenue and the expenditure side to believe that inflation fiscal is actually going to come down. So I think broadly, I would say both on monetary and fiscal, we need to regain credibility.
Thanks. So now who wants to come next quickly? DK.
Yeah, so I think first of all, since the last policy, I think inflation risk has gone up significantly. I think that is very clear, I think, from all sides. So I think I would agree with Dr. Acharya that stance needs to be changed, because without that, the interest rates won't change. And then we, as CRISIL, are expecting 50 to 75 basis rate hike in the coming fiscal year. So the second is on the strategy of the government is to revive growth, is to push infrastructure investment up, and then that will lead to growth, and then it will also help consumption. But the point is that the consumption has not reached the self-sustaining level, and it will not reach that it will take some time. So till the time it reaches there, I think there is need to support the smaller segment. I think I completely agree that I think there has to be direct support to them. Otherwise, I think the pain will increase only because of now higher fuel inflation.
Rajeshwari.
2-3 suggestions. One is that I think the RBI should go back to the legally mandated objective of price stability, and maybe the government should instruct the RBI to do so, because we have seen from our 2019 experience how fast inflation can spiral out of control. And currently, I think we are underestimating the risk to inflation. And relatedly, I think we should normalize all the rates that have been addressed during the pandemic period and go back to the situation where we had a fixed rate liquidity adjustment facility corridor where the repo rate was relevant and the reverse repo rate was moving in consonance with that. So I think we need to go back to that. And the RBI needs to communicate to the market transparently that it is doing that. And I think a third point related would be that the MPC's discussion need to widen a little bit, because right now we are talking about RBI managing bond deals. I won't be surprised if soon the situation comes when the RBI is managing the exchange rate. And then again, we are talking about this dilemma and trilemma and quadrilemma of the RBI.
Okay.
So I think all of that needs to come within the discussion of the MPC, because this affects monetary policy. One last point, Kamal, is I think the biggest crisis now, while we're talking about inflation, etc., is also growth and jobs, because private investment has been sluggish for a while. And I think a lot of thought and consideration needs to be paid by the government as to why that is happening and what steps can be taken, because the only way to come out of a high debt scenario is to have a high growth.
Thanks, Rajeshwari. Before Ashima has a last word, Anand, over to you. 1 minute. Just a minute. Yeah.
Sure. I'm going to stick to RBI and MPC, and I'm going to stick to inflation as the objective. Okay. Now, because we've started to program ourselves to think that repo rate controls inflation, which I kind of droned on about for a long time, I completely disagree with that. high liquidity, banking liquidity, and low interest rates that at this point of time, when your credit offtake is just at 7.2% CAGR over 2 years, is not creating inflation by itself. It's not creating money. Okay. Only when credit offtake goes into 12, 15, 17%, that's when you have to worry. So I don't agree at all that liquidity or short-term interest rates are causing inflation at this point in time. However, longer end financial suppression of rates, the fact that RBI has sat on the interest rates for a long time at 6%, the 10-year bond yields, you have created negative real interest rates for savers, for medium-term savers, and therefore you've pushed money into gold. Last year we bought $50 billion worth of gold imported. Okay, that's because you've kept your real interest rates low, and therefore money has gone into equity markets, has gone into gold, has gone into Bitcoin, God knows what else. Longer end rates can be higher. The fact that there is a fiscal problem, our entire macros are going to look very, very bad out of syllabus Ukraine war. Longer end rates can be right. Government should pay the right price for borrowing what it is borrowing, and that will bring a lot of financial stability in the picture.
Thanks. Last word, Ashima. As you said, you represent India. And you represent Rohit Sharma, actually, who is the captain of all form of cricket.
No, I'm just an unimportant member of the MPC. And these are my personal views. I have my own view as a researcher is that the last decade and the sort of growth slowdown or lost decade for India was because we overreacted to external shocks. So as a policymaker, my view would be try to smooth the impact of external shocks on India as much as possible with paying full attention to the inflation targeting, etc. And then this thing about the RBI being behind the curve, I disagree with that because my view is they started adjustment last year. In the Indian context, in the US, interest rates are very low, near zero. So what they pay banks is very little. Here, if you without withdrawing some excess liquidity, you start raising rates, it can be very expensive. I don't know if Viral agrees with that. So you need to first withdraw liquidity, and they started doing that. And now, given the external shocks in the current environment with Ukraine and so on, we'll see outflows. We'll see liquidity flowing out very quickly. And in fact, we might switch to a situation of where liquidity is too low, which happened in 2018. So we need to make sure that, and part of the reason why the reverse repo has been de-emphasized is that we are following the reforms that Urjit and Viral started, which is that you move to a liquidity management framework where the repo is around, the repo is the only relevant rate, the reverse repo is irrelevant. So the liquidity management is such that you stay around the repo, and with the VRRRs, that is what is happening in effect. So the RBI is not behind the curve. The signals, they tried to say it's rebalancing, the market took it as adjustment has started and factored in so many rate hikes which were sort of not correct, because an adjustment has to be gradual, otherwise it can hurt jobs and employment, create large output sacrifice. So we are doing the gradual adjustment. Remember, the US Fed has only said that it will start withdrawing QE in March when their inflation is much in excess of their target. Our inflation is within our tolerance band, and we started withdrawing liquidity since last year.
Thanks, Ashima. I thank all of you for being so candid. And unfortunately, it's 8:27, so I would not waste time. I would not summarize. Let Samir Kocha, who's the organizer and who's hosting the show, come in and close it. We have already exceeded our time, and we could have actually, trust you, we could have gone on till 1 more hour and with more points and more interesting debate, but unfortunately run out of time. So from my side, thanks all of you, and over to you, Samir.
Thank you very much, Tamal. This is way above my intellectual grade, the kind of discussion that you had. I understand very little of all the things that you talked about. I came into it very apprehensive and worried. I am getting out of it even more apprehensive and more worried about where the economy is going. That's the sense I got, not that I understood very much of all the big jargons that were discussed. And I hope that discomfort is ill-founded, and we are actually doing something right, and RBI does have its credibility intact. It has not, in fact, become an extension of government of India, which it is not supposed to be. And I hope that there are better days ahead. What I really worry about is that there are very few spaces left for this kind of a candid discussion, open discussion and academic discussion. We are possibly the last guys standing, still supporting it, still funding it, without any sponsorships, without any support, and at the same time doing this for India without any fear, saying that this is what we believe is good for our country and we must all stand for that. Well, yes, plurality of view is welcome. It is the sense of democracy, but plurality must come with credibility. Whatever you stand for should be seen, you should be coming from an honest space, is what I believe. And as long as we are all doing that, then we are doing a great job. Thanks a lot, Dr. Viral Acharya. Thank you, Ashima ji. Thank you, Dharma Kirti. Thank you, Sonal ji. Thank you, Rupa ji. Thank you, Gusharan. Thank you, Dr. Anant Narayan. Thank you, Rajeshwari. And thank you, Rohan, for sitting through this. And look forward to many more such discussions. And hopefully some of the outcomes that we document will get implemented. And hopefully through this platform, the concern of everybody is getting amplified and communicated. Namaskar.
Thank you.
Thank you.
Thank you so much, everyone, for the candid discussions. That was great. Thanks a lot.
Thank you.
Just one thing, there are many questions, but I could not raise any one of them because everything has been discussed. So that's why I did not take any questions. Okay. So thank you all. Stay safe.
Thank you so much.
Thank you.
Very well fielded, Viral. Very well fielded. All those bouncers.
Yeah, it was really good to have a frank discussion.
Yes.
Yeah? And I'm sure everybody realizes that we all want the best for. Yeah, and we're trying to understand that elephant in different ways. Yeah. Thank you. Bye.
Bye.